Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And so today we're going to talk about paying off maxed out credit cards with Velocity Banking. And it's not a secret that there's a lot of credit card debt in this country, right? In fact, just a recent story here we should watch about breaking down record high credit card debt. And let's go ahead and just watch a little bit of a clip.
So today on Good Morning America, we had a first look at some new data that shows record high credit card debt and more Americans falling behind on their credit card payments. So this is an analysis from two groups, the Century Foundation and Protect Borrowers. And what it shows is that 111 million Americans, so that's about 40% of all US adults, are carrying a balance every month on their credit card. So they are not paying off those bills in full. Of that, more than 27 million Americans can only afford to make minimum payments every month.
So let me just stop there. So if you want to know how a bank makes money, essentially if you just make minimum payments, that's when they win, right? Minimum payments is when they win. Now, I know that in society we encourage people to make more than the minimum payment, and what stops most people is that they're also encouraged to save money. So, given that they're fed two, let's say, somewhat contradictory ideas, what we're going to do is just give one of those up using something called velocity banking. And that's what we're going to do to pay off maxed out credit cards today. So this is what I love to do is that I love to always show this example where we have like 10 maxed out credit cards, an auto loan and a mortgage, and we have our other expenses. And I say, hey, let's say you make great money and you have this much in expenses, so $10,378.30 in income and $10,378.29 expenses, and 1 penny left over in checking and savings, right? Um, is there anything you can do about this, right? That's kind of essentially how I ask it. And the way that this is where I kind of start off with teaching velocity banking, and I sometimes think that I probably need to slow down and just kind of focus more on the basics because there are a lot of people out there who can't even use Excel, right? There's a lot of people out there. I didn't realize that until recently, but there's a lot of people out there like that. And so sometimes I actually go through 8 hours of materials in like 20, 15 to 20 minutes. And and that's why I'm actually thinking of starting a new channel, kind of just on a tangent here, where I just kind of focus on high income earners and then maybe like sell a service to them, helping them out velocity banking. And the reason that I might focus on that is just because it's a lot easier to get paid. You know, if you ever deal like, and now I've been in this situation too, as someone who doesn't make a lot of money, but sometimes you need someone's service just to survive, and then they act like you're the worst person on earth because you don't have money, right? And my philosophy on this is that in this money system, make money from the people who have it, and then if you're in a situation that deals with people who don't have money, then that's what charity is for. That's what it's much easier to serve lower income when you have money, and it's easier to get money from higher income people just because they have a lot of it, and not every dollar needs to be scrutinized, at least in their maybe in their experience, right? I might be wrong about this, but that's just how I feel. And so anyway, I was just kind of babbling on and on. So the biggest problem that you have to understand that as you make more money, you become a target for the bank, right? Because who is the bank's favorite customer? The bank's favorite customer is someone who does not need money. So once upon a time, you did not have these 10 credit cards, okay? And when they see that you did not need money, they're kind of like a vampire thinking, "Whoa, this person has a lot of fresh blood," right? Vampire sees a person with fresh blood, they're a target, and so they want to start targeting them with mailers, advertisements. You've been pre-qualified, and so they're essentially looking for that fresh blood. Okay. And then once they've drained too much of your blood, aka your leftover money, your leftover checking and savings, then you'll notice that they want absolutely nothing to do with you. They won't issue you more credit, right? Like they won't do that because banks don't lend money to people who need it. And it's actually right for them to do that because if they did lend money to people who need it, guess what? They wouldn't be paid back. And in 2008, that was a very harsh lesson of lending too many money to people who needed it, and people who need money don't pay you back. And I think that was how the economy got crashed, right? but I don't know what I'm talking about. Anyways, all right. So now what we're gonna do is pay off this debt. And if you just show this to let's say like your buddies, your friends, just say, hey, you have 10,300. Let's say you make this good income, $10,378 after tax, and you only got one penny left over because you have all this debt. What can you do? And let's say you make the same income, but maybe you could borrow some money. So what we're gonna do is we assume we have the same income, right? Same income, control paste. We're gonna have the same expenses, same debts, but we're gonna do the exact opposite of what traditional banking tells you to do, right? So traditional banking tells you got to save money, but we're not going to do that. So we're going to put the checking and savings to here at $0, right? And we're going to focus on this number called cash flow, which kind of looks like our checking and savings in the beginning. Now, let's assume we have access to something called a line of credit. What's a line of credit? Basically, a financial tool where you can borrow money, pay it back, and use it over and over again. So, a credit card does fit in this category, although a credit card's a little bit less flexible. And if you want, let's say, an 8% interest rate with a big limit, you do have to provide a form of security. In most cases, it's going to be a home equity line of credit, meaning you would be a homeowner, right? And so, if okay, the bank gives you a $200,000 free and clear line of credit at 8%, would you be in this situation? No, because banks don't lend money to people who need it. So there's a little bit of unrealism here that we're going to talk about because there's a certain order we have to do things, but what I want to show is that if you did have access to a free and clear line of credit, could this completely change the situation, right? And so I don't know if you know this thing called the cash flow index I talk about all the time in the channel, but basically it's a formula of the debt amount divided by the monthly payment, right? And you just kind of do this with all your debts, listed as a line item, and then you get this number, right? So think of this as a sorting and ranking system. The lower the number, that's the debt you want to pay off first because you get more bang for your buck in terms of cash flow for paying off that debt. Whereas the higher the number, that's the one you want to pay off last because it doesn't give you that much bang for your buck. So if you compare this, I'm going to pay off this credit card and this credit card and get about $2,000, a little bit more than $2,000 in my cash flow. Whereas if I pay $330,000, I get less than $2,000 in my cash flow. So it doesn't make sense for me to pay off the mortgage first, right? Less cash flow. So that's just the system that we use. It's not foolproof because it doesn't take into account the interest rate. So you might have a little efficiency here and there, but in my opinion, this is the easiest way to pay off debt, or it's one of the easiest. Okay, so what we're gonna do is let's just assume that we have this line of credit, 200,000, and then we just move all our credit cards in there. This low cash flow index number. So it's 5, 8, 15, 27, 37, 10, 35. And then I'm going to go ahead and sum it up. Is that 137? No, that's not right. It's 35 and 12. So let me go ahead and sum it up. Sum up the cards. Is that 184? Did I? Okay. 35, 10, 7, 30, 27, 15, 8, 5. And then, no, it's 12. My bad. And then that's 15. Okay. $164,000 of credit card debt. So if you sum all of this up, that's the current balance of all the credit card debt. Now let's assume that we move this credit card debt here. Remember, we're maxed out. We only have a penny left over. Okay. Let's just assume that we just did the equivalent of a balance transfer. Well, guess what happens here? Oh my goodness, these all turn to zero, right? So now we literally turned a penny into $5,160.72, and we didn't even make more money, right? So here we're struggling because we're essentially just making minimum payments on everything. Here, okay, we just kind of changed the debt tool. And last step is we're going to put all of our money into the line of credit as an overpayment, right? So instead of paying the minimum, we're going to pay everything into the line of credit and then take our expenses out. Because remember, a line of credit gives you the free flow movement of money. You can pull out money whenever you want. You can put money whenever you want, as long as you make the minimum payment. And the minimum payment is usually just the interest that's accrued for the month. Okay, so this is assuming that we do make income, and we have to understand that velocity banking is not going to fix every single situation, because if you're making $5,000 a month and you have $15,000 of debt, there's another tool that will help you for that, which is bankruptcy, right? So there's different levels of how to manage your cash flow, and then the ultimate reset button is bankruptcy, right? And so um, it's like a reset switch, and I think this is my understanding that the founding fathers, is it the founding fathers or someone in the government, wanted a way to people to take risks, or at least that was the philosophy of this country, so that if they get into bad decisions, they could restart. Now, I know that it's still emotionally hard, so don't think like, oh, bankruptcy is easy, right? And I'm not a lawyer, so I can't give legal advice. But what I'm saying is that if you're in a situation where you're struggling with your cash flow because you're in debt, but you make money, then velocity banking may be appropriate for you. But if it's like, oh, $10,000 of income, but $50,000 of debt payments, I think you need to hit the reset button, right? But I can't give you that advice because I'm not a lawyer. Okay. Now, final step is you put your entire paycheck into the line of credit, take your expenses out, and then rinse and repeat over and over again, right? So how do we calculate that? Basically, a previous month's balance minus previous month's interest minus the cash flow, so 5160.72. And then what we're going to do is take the average daily balance, right? So this is right here, average, multiply it by the interest rate, divide by 12. Okay, and then we're going to go ahead and copy and paste, and copy and paste. Okay, and then we see that in 36 months paid off, right? So we paid off all the credit card debt. And I'm wondering if I should just stop here, just say, hey, just soak this in a little bit. Um, Credit card debt is finished. Try to copy the Excel sheet yourself. And, I've probably taken for granted all the things that I've known because, there are a lot of people out there who don't know how to use Excel. A lot of people. I didn't know that, but I just thought I kind of take it as a given. Oh, most people know how to use Excel. No, they don't know how to use Excel. Most people don't. Excel is kind of a hard tool to kind of get a hang of in the beginning, but once you get to know it, it's just kind of like using a calculator. Free calculation, free flow calculation. I think that's the best way to put it. Now, this is what we're going to do. We're going to put a milestone, 36 months, and that's $164,000 of credit card debt. And remember, we started with a penny, right? So, you know, uh, what did we do that was so special to go from here to here, right? First thing is we didn't just make monthly minimum payments. We put our entire paycheck into our debt, and we consolidated our debt to increase this cash flow, right? And so, a lot of people get freaked out about this. How to go from here to here, and yeah, you just practice over and over again, you'll eventually get it. So here we have a loan calculator. So if you have a couple factors of the loan, which is the original balance, interest rate, and the term, you calculate the payment, right? And then you can actually put in the monthly payment, and the monthly payment is 36 months, so 36. Or no, I'm sorry, not the current month, right? And so it spits out the current balance, and then you have the current cash flow index. So what we do is we move the car balance into the line of credit and see how long it takes us to pay off the car. So how long does it take to pay off the car? Plus 12541.78. Whoopsie. Okay. And so now we've done that, and let's go ahead and increase our cash flow. So this is our auto loan, and then now our cash flow is about $5,700, right? So let's go ahead and do that. Control V. And go ahead and copy and paste. And then this is going to be 5699.78. So 5699.78. And then bam, bam, bam. And we see that the auto loan's been paid off in 2 months. And now all we have left is the 30-year mortgage, right? So 38 months is when the auto loan is paid off. And 38 months. And so 194K. And then now is just the 30-year mortgage, and we're good to go. So what's the current balance of a 30-year mortgage? It's going to be $316,000. and we've kind of paid a lot of interest. Like if you take a look here, this is the total interest paid on that 30-year mortgage. Isn't that crazy? So we got, if we go to the full term, which is 360, right? We're going to pay $382,000 in interest to the bank. So it's not just paying it's literally not just paying the this original balance 330,000 to the bank. It's 330 plus 382, meaning you're actually paying more in interest to the bank than the value of the home that you bought it for. That's the crazy part about these mortgages, and this is why banks don't want to own property. They only want to lend on it, because if they lend on your property, right, then they don't have to deal with the hassle of dealing with tenants and all that nonsense. You just deal with the homeowner who needs to pay their mortgage to live in their home, right? And it doesn't mean that everybody pays off their home or pays their mortgage, because obviously, if that were true, then there would be no foreclosures, right? Foreclosures would not exist if everybody paid off their mortgage or paid their monthly mortgage payment. But the bank does not want to take your house. Like that's literally what they don't want to do. What they want that is that stream of income over time so that they make more in those payments than the original balance of the loan, right? That so you're paying like double for the house. All right. So now let's just kind of go back here. Um, and there's two ways that we can pay it off, right? So the first way is something called just doing an extra payment, right? So you just make the monthly payment, and then you put an extra payment of $5,699.78. Now, realistically, I don't think most people will do that, because when you dump all of your money into a loan, then it's like, whoa, I dumped all my free cash flow into a loan, and once you overpay a loan, you can't really get it back. Now, I know people say, hey, use a credit card as a backup. The reason why that's a little bit difficult too is because you don't want to segregate your income over again, right? So it's because how did we get here in the first place? We just segregated your income. And segregation of income is your money comes in, right? And they get split all over the place. You're essentially making minimum payments on everything, and you leave the leftover in checking and savings. So we're just trying to prevent that. And the easiest way to prevent that is just you still dump your money into a line of credit, right? And a lot of people freak out about this, 6% mortgage, 8% line of credit, and you see kind of the housing market react if there's like a 1% difference, and if there's a 1 or 2% difference, then the amount of buyers that go into the housing market magically increase. And so as long as you get the right price for the 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 house, that matters way more than the interest rate itself, right? The interest rate itself is just kind of, optional in a way, because think about it, if you won the lottery, you win the lottery, then you pay off the house and the interest is optional, right? So that's the way that we kind of think of it. All right, well, so let me just kind of show you something. Give me one moment. So here, if you want to use a line of credit to pay off your mortgage, you can do that. This is calculator right here that just kind of has all the details. I actually got this from Renatus, so if you want to know where I learned velocity banking originally from, it was from Renatus. And so let me go ahead and just type in the details here. So what you do is you put in all your income and your expenses. So this here, and then all the expenses except for the loan you're trying to pay off. So you're trying to pay off this loan, so you're just putting these expenses. So what's our income here? So 10378.3. So let me just do this. 10378.3. And then our expenses are 2700. And then look at the balance, the original balance and the current balance of the 30-year mortgage. So 330,000 is the original balance, 330000 at 6% for 30 years. And then what's the payment is 1978.52. So 1978.52. And then what's the original balance? The current balance is 316,289.21. So 316,289.21. All right. So now, how much should we move into a line of credit? I'll just say something comparable to your monthly income. So we'll say 11,000, and then we see that it gets paid off in 4 years. Okay. So bam, 4 years, we're done. No more mortgage. No, thank you. This is 0. So now what we do is we do 38 divided by 12 plus 4. So that's 7.17 years. And we are completely debt free, right? Completely debt free. And so now, if you look at our free cash flow, it's about $7,678 a month. So you have a lot of leeway, right? And we did this by essentially making more than the monthly payment or minimum monthly payment and dumping all of our money into debt, right? That's really what velocity banking is. It's just dumping all of your money into debt and then just using a line of credit to help you free up your cash flow. Okay. All right. Well, that's it for today, folks. Korean Lantern Mentorship here with another video. So just let me know in the comments if you have actually been successful sharing this information with the people that you know and love, because there are people in your life you probably want to help, and ironically, random strangers are probably the most likely to open up to you. It's kind of weird how our society works, right? But I've heard this various times. But let me know in the comments. Let me know your thoughts, and if there's anything you want me to cover, I'll start doing that going forward because the reason I created this channel is so that I actually could get better at velocity banking, believe it or not. And I was just like, oh, what do I say? Line of credit? And then now it's like, I just kind of crank out videos like it's nothing. All right. All right. Well, have a great day, and I'll see you on the next video.